Let me start with a number that stopped me in my tracks. 71%. 71% of Australian property investors own exactly one investment property. That is not an opinion. That is ATO data. And for years I thought I understood why most people stopped. But after working with over 1,000 investors across Australia, Dubai, and the US, I now know the exact reason. And it has nothing to do with the market. Here are the 3 reasons. I want you to listen carefully because at least one of these will sound familiar. Reason number 1, they bought a property, not a position. Most first-time investors buy their investment property the same way they buy their home. Emotionally. They love the suburb, they like the street, the house has a nice kitchen, and when the investment performs, they feel like they got lucky. When it underperforms, they assume property investing is harder than it looks and they do not buy again. Reason number 2, they hit a borrowing wall. They bought their investment property, used the equity in their home, and their broker told them they could not borrow anymore. So they stopped. What they did not know is a borrowing capacity is not a fixed number. It changes based on your income, your debt structure, which lender you use, and crucially, which market you're buying in. The investors who keep building do not accept the first number they are given. Reason number 3, they had a no plan. This is the most common one. Most Australian property investors have no written investment strategy. No target, no allocation framework, no criteria for what the next property has to do. So when the next opportunity comes, and they always come, and they have no framework to evaluate it, and they do nothing. Here's the single most important shift in thinking that separates investors who build real wealth from investors who stop at 1. A property is an asset. It generates rental income. It sits in one suburb, one city, one country, exposed to one economy, taxed by one tax system. A portfolio is a system. Each asset inside the system is doing a specific job. The Australian property provides stable capital growth and borrowing capacity. The Dubai property provides zero tax cash flow that can be redirected anywhere you choose. The US property provides monthly income in US dollars regardless of what the Australian economy does. These are not the same thing. A collection of properties is not a portfolio. A portfolio requires intention. Every asset has a role. Every market does a different job. Every dollar is allocated with purpose. The 71% who stop at 1 never make this shift. They stay in property thinking. They never get to a portfolio thinking. If you want to build beyond one property, and I believe everyone watching this has the capacity to do it, here are the 3 decisions that create that shift. Decision number 1, define what the next property has to do, not where it should be, not what it looks like. What job does it do? Does it generate cash flow? Does it give you borrowing capacity? Does it hedge your existing Australian exposure? Write that down before you look at a single suburb. Decision number 2, stop letting your existing structure limit you. Most Australian investors borrow against their home in personal name and never think about structure again. As your portfolio grows, the structure matters more than individual property. Tax, asset protection, estate planning. These are portfolio level decisions that need to be made before the next purchase, not after. Decision number 3, expand the market you're looking in. The biggest mistake the 71% make is only looking within Australia. 100% of their exposure sits in one country, one tax system, one currency. The investors who build faster add a second market, almost always Dubai, because the zero tax cash flow from Dubai accelerates the compounding on everything else in the portfolio. That is the shift property to portfolio, single market to global, reactive to intentional. If any of this resonates, And I suspect it does, or you would not still be watching. The first step is a strategy session, not a sales call. A genuine conversation about what your portfolio should look like, which markets make sense for your situation, and what the next move actually is. The link is in the description. I will see you in the next one.